All right, guys, we're going to go ahead and get started with the State of the Funds presentation by Mr. Robert Buchanan.
Thank you, Tibet. Welcome to everybody, or you've already been welcome. I hope you really enjoyed the presentation by Eldon. I think he's real in touch with what's going on in our area. I came across Eldon a couple of years ago, was really impressed. I think he spoke at a HBA beginning of the year beginning of the year forecast, maybe in 14 or 15, and I have to give props to Amin. Amin was able to secure Eldon, and I was really surprised, to be honest with you, because Eldon talks to 1,000 people, audience, and so for him to come to talk with us, I thought was really good. So anyway, so here we are, State of the Funds. I appreciate everybody for coming. First off, I want to apologize for the direct deposit fiasco that went on this past quarter. Tried to go save, as some of you, I told you, we tried to save a few dollars with the ACH, go with the local bank, who I won't name, but at the 11th hour, they decided that it was too much of a risk.
The first time is always the hardest time.
All right, thank you, Ed. So I just want to, I have egg on my face for that, and they kind of really put the quarter, or getting everything out to everybody in a tailspin, and I apologize. But going forward, we're already secured with Frost. The cost is a little higher, but Frost is Frost, and we haven't had a problem with them in 9 years, so I don't expect anything going forward. Also, we're looking at updating our software for the two funds. Earlier, a couple months ago, the mortgage office, which is an industry software that's used by quite a few funds and private lenders, has updated their software to now include interface with QuickBooks. And so we use QuickBooks to do everything. Previously to that, there was no interface, so basically you had to keep two sets of books. And as an ex-auditor, I just, two sets of books, I don't like the sound of that at all. So that's why we never used it from the start, but now we're going to start looking into that and make sure the interface is there and it works good like it's supposed to. And if that happens, then we'll get that. And what does that mean for you guys? Well, it means that it doesn't mean real-time access because we close on quarterly basis, but basically you're not going to have to wait the amount of time that you've had to wait to get statements and those things, because it'll be a lot faster. And so that's what I want to do, is try to keep improving our process over here, even though we took a step back this quarter, but keep moving forward, with the use of technology, and try to not work harder, work smarter. So anyway, I just wanted to put that out there before I start. I appreciate everybody's patience on that. So State of the Funds, kind of mix it up a little bit from the past. We've always started with, well, here's the legal of the fund and blah, 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 and here's the legal of the other fund. But I felt like we needed to talk about a little bit about the management, just so you know who's managing these two funds. So nothing's really changed across the management team, same people. I've been blessed to, when we bring somebody on our team, it's not a revolving door like other people in the industry are. Amin's been part of the organization now, starting his fourth year, or getting close to start his fourth year. Ryan and Tibet now are starting their second year. Of course, my wife's been by my side for almost 10, so, and of course my mom has always been by my side, so. So without them, this wouldn't be possible. So, stability, I think, in this industry, whether it's a good market, low market, you need to have stability. You need to have people around you that, is a team, and that's what we are. So anyway, so basically Capital Group, CCG Capital, the manager of the two funds, we were established in 2008 as Pride of Austin Capital Partners. Most of you know that. And what was it, last year we did a name change across the board. So we Pride of Austin Capital Partners, Pride of Austin Homes, all that. All we did was a simple name change over to the CCG and then whatever industry or entity it was. So it was organized as a LLC in Texas, the manager of the 2 Reg D securities. The members of Capital Group LLC are also investors in both funds. So I think that's important that we have skin in the game. And unlike I don't take the advice I give to you guys. I say diversification. I don't want all your money, but this is the only place I have my money because I don't want to invest in the stock market. So I have substantial skin in the game, managing member myself. And then we have an advisory board. I think I got tripped up on a question, I think, by you, Ms. Rhonda, last lunch and learn about this. So I wanted to make it clear. We have an advisory board that's the members of the LLC and also industry experts. So we have an attorney on there. We have a commercial broker on there, appraiser on there. Who else is on there? We have a fund manager, Mark from Alpha Funding. Christina Korich is on there, who helped. We have to give props to them for letting us use their space. But I think that's it. It's about 6 industry experts, and then the 4 members of the LLC are on the advisory board.
Robert?
Yes.
So I'm a little bit unclear. Is that in place, or is there something separate than the board of directors?
There's no board of directors. I think that's where I got tripped up. There's no board of directors. So you have, in the management company, it's an LLC, and there's 4 members of the LLC. And so I'm the largest, I guess, member, and then there's 3 other members. I'm the managing member. So there's no board of directors. I don't believe we ever had a board of directors. I think I answered the question incorrectly last time. But we've had an advisory board in place for a long time. So does that answer your question?
Yeah, sure. Yes.
Okay, but if it doesn't, if I'm not, if we're not linking up, please. Yeah.
So there's no Congress, but you have the president's cabinet.
Yes. I don't want to get political. So the management company, we service the loan, so we get 1% annually of the loan balance. So basically, we break that down by quarters. If it's the high yield fund, semi-annual if it's the opportunity fund. We don't receive any performance bonus, so we have a great quarter. The investors get to share in that. I don't get any, the management company doesn't get additional money for that. Earns broker points paid by the borrowers. So typically, 3 points is an origination at the closing. Sometimes we try to get 4 to 5 points, and so anything in excess of the 3, but typically it's 4 in this market, and so that's what helps pay salaries and overhead and that sort of thing. Because when you look at 1% of the for the manager, that's very low in this industry. It's not uncommon to see 2-3% on a fund balance and 2% on loan servicing. So we're very lean. So alternative investing, why should you invest with alternative investing? Well, passive income. Investors not responsible for due diligence. Jim Lloyd, investor, I don't think Jim's here today, but I'll use him as an example. Jim, long-time landlord, and has been over the last 5-6 years. Would you say that's right? 5-6 years he's been selling off his property. And so he's tired of being, the landlord. And so when he sells off, some of it comes to us and some of it goes elsewhere. But now, so Jim's not working as hard as he used to. He's working smarter. So passive income. So basically, investors not responsible for due diligence for each loan. Obviously, you all do your due diligence on the manager of the fund. But as far as, going through each deal, that's not necessary. So mailbox money, that's kind of the passive income. Mailbox money now is going to turn into direct deposit money. Hopefully that would have already happened, but it's coming. So be the bank. You've heard me say this before. lending money. We have the money, we have the gold, we lend it out. You're investing in a tangible asset, backed by real property. So outside, investing in stock market bonds and stuff like that, where you have a piece of paper and you don't know what it's worth from day to day, hour to hour. This, you have a tangible asset. You can actually touch it, feel it. Then why is private lending, why are we here? Well, you got conventional banks, I heard Eldon talk about Dodd-Frank. Dodd-Frank is still, it comes out in phases. You have different phases still coming out of that bill, that large bill that came out because of the meltdown. They're still not lending. I heard months ago that for every dollar that a conventional bank lends, they have to have $2 in reserve. So if they had, that really, think of it if we had to do that. That would just, basically our net yield to investors be cut in half. So it's why lend the money? That's why they're not. We're, asset-based lending versus credit-based lending. We're looking at the asset. We're looking at the general contractor. We're looking at the exit strategy. Flexibility. We have the flexibility don't like to in the 11th hour, but along the way of underwriting or a loan, we can kind of shift gears a little bit. If something comes up, we have the flexibility to kind of move around some obstacles, as long as we still are within our lending parameters. And then faster underwriting. We typically say we can, once a potential borrower gets us all the requested documents in a letter of interest, we can typically close in 2 to 3 weeks. So that's a lot quicker than most conventional banks. Underwriting. So I mentioned guard our lending parameters. We set our lending parameters, and we might want each deal to go over them. We're not lowering the bar each time. I speak about this every year at our annual conference, kind of going through underwriting of construction loans and just any loan really. But you set your lending parameters and you stick to them. Makes it easy to, you're not having to, well, what parameter did I use for this one, or what parameter did I use for that one? We know what they are. And after 3 years, Amin knows what they are too. So he filters those through. So when something comes across my desk, I already know, I check it, but I already know that it's going to meet our lending parameters. Underwriting, we look at the asset. I wanted to move the contractor up because it's not last place. It's really right there. Asset, contractor, and exit strategy are really on the same plane. Those three, I think, have equal importance there, because we got to believe in the asset first off. We got to believe in the contractor who's building or repairing the asset. And then the exit strategy, how we're going to get our capital back. If there's a fault in one of those, then we're going to pass, or we're not going to. Yes, Jerry.
In the context of the contractors, I presume you're saying that you're looking at their behavior historically in their operations.
Correct. I take my past experience in doing loan reviews at some regional banks in Central Texas back before I came here, where I started this. And basically, I take the same underwriting that they've done and put that. We've actually, one of our most recent ones that we turned down, we were questioned whether we were brokering it to a conventional bank because of the way we were underwriting it. So if that gives you any indication there. So yes, but to answer your question, let me get there. So we're looking at on a contractor, pending the scope of the work, but a big general contractor, Ellen can probably agree with me. We're looking at their work in progress, their WIP, their completed work, their financial statements, their tax returns. I mean, we're underwriting them from start to finish, like almost they're going on the note. They're almost the bar. So if they don't have the stability or the experience to do whatever project A is, then they're not going to cut it.
Do you have, or is it a reasonable presumption that you have sort of a blacklist of contractors that when you see an application come?
Yeah. I know. Oh, there's a lot of bad actors out there. Ellen and I've worked through. Ellen and I've worked through a couple of them. you know, and
Share that with us?
no, I won't do that. But anyway, so those three items are really very, very important. And then the bar of financial stability. I don't want to, that's not way down here. I mean, we want to make sure that they can service the debt. That's important. But it's not as important as the first three. Consistency, you know, we're consistent in whether it's our lending parameters, our transactional attorney, our escrow office, you know, whether it's Heritage or Trinity or, you know, but there's only a couple that we'll go to. So we're consistent in what we do. And then never put out money just to make a loan. You know, as an investor and thinking of the, you know, walking in the shoes of an investor, I'm not the manager that's just going to make a deal just to make a deal, just to put money out there. If it's slowed down in the market, my strategy would be to send out an email. Who needs money back? If, you know, 2 people say it, and I still got to get $5 million out back. Hopefully that's not going to happen, but you know, it'll be across the board percentage. So I would rather give you your money back rather than have it sit idle, drawing down the yield. I think, you know, that's the right way to do it. We don't want to just make loans just to make loans. So what goes into servicing? Servicing, we do invoicing, of course, interest and late fees. We do inspections. Inspections we're doing for draws, so it's a construction loan. We're out there inspecting before we release the money, make sure that it's actually been done. On the residential side, I've got my foot pretty well in the ground on that. On the commercial loans, I've got Ryan Stewart, who's spent about 5 or 6 years with Turner Construction. So if there's a question or I need to draw him in on a commercial loan, construction loan, he's got the experience to look at plans and speak that language where I lack that experience. So we have that. Down date title, we want to make sure we're, as the loan balance increases, we're increasing our title amount. Value checks, we're not experiencing that now, but if there's a little downturn in the market, we may need to check our appraisal amount, make sure that we're still okay with our loan to value ratio. In our loan docs, if there's a decrease in value by an independent appraiser, then we have the ability to make the request that the borrower will make the borrower pay down. So we would keep that LTV in line. And then communication. I spend a lot of time, more time than I do with investors, communicating to the borrowers, because that's how I'm protecting the capital. That's how, you know, we don't have a lot of non-performing and our REOs, and we got a good, because we're constantly communicating with our borrowers. Even if we don't really need anything, it's been a week, 2 weeks, we're out there communicating with them. Let them know that we're still thinking about them. Loan exit, typical loan exit here. Payoff is obviously the most desirable. An extension, if they're not right, if they can't fulfill their exit, and then an extension, we extend the note. That costs them money. Typically it's 3 points. A workout. Now we're getting into some areas where we kind of, you know, we got to give and take a little bit here. So we work out. Maybe we have to, you know, extend but not have a fee, an extension fee up front. Maybe we collect it on the back end. Maybe they're at the end of their extensions, but they need another extension, and this time they have to pay. They're paying for an extension. We're not increasing the loan amount or waiting for something on the back end. Foreclosure. That's you know, we all don't want to see that, but in this, it's real. So we do have foreclosures, but then when we do, we want to liquidate them. I think we've done a good job on liquidating some of the REOs that we've had. We've got a couple that are still hanging in there, but I'll get into that in a few minutes. But I think we really see the light at the end of the tunnel on a couple of them.
Robert, I have a question about the previous slide.
Sure.
You're talking about communication. I'm curious to know, is that also...
This slide or the one before that?
The one before. If you try to look at it, just... you were talking about communications.
Yes, sir.
And I was thinking, is that also acting as watchdog? In other words, making your presence on a frequent basis, like, okay, this guy is always checking in on us. We can't... If we're saying we're at 75% complete, he knows it because he's been here kind of thing, and just sort of always keeping our eyes on things. Is that...
Yes. That's part of the deal. It's like, definitely watchdog. It's like they want to draw for this, and okay, well, I need the inspections, or I'm anticipating that they're going to request, the next draw is going to be this. So I'll ask them, do you have your final electric approval from the city? And just let them know that we're there. We see where they're going. It's a watchdog, yes. Okay, so now that kind of tells you a little bit about the management. Previously, we always pushed the opportunity fund to the back, but I think it deserves its day up front. So some legal here. Regulation D security, filed in all 50 states. It's an LLC in Texas. Investors are members, and it's owned by investors, 100% owned. We do not leverage the fund, this fund, or the high yield fund. We've never leveraged, and we never will leverage. That gets a lot of people in trouble. And I would rather we have a little dip than to start leveraging assets. Then we get in trouble if there's a downturn in market. I'm not out there chasing an extra point or two by putting us at risk. So opportunity funds, accredited investors only. Unlike high yield fund, which was established 2009, it can take in some unaccredited investors as long as they're sophisticated. Opportunity fund, since it was established in 2014 after the meltdown, it can only take in accredited. $50,000 minimum investment with a 2-year lockup period, semi-annual distributions, so June 30th and December 31st, and again, 100% owned by investors. I guess we want to make that clear. So in this one, what makes this one a little different from the high yield fund? Second liens are permitted as long as the first lien is held in the high yield fund. Just about everybody that's in the opportunity fund, I think there's one or two, are also investors in the high yield fund. So I appreciate your loyalty and your trust. So, we do second liens, but we're only doing them if we're in control. We won't do a second lien if Wells Fargo or Chase or whoever, or even Stallion Funding is the primary, the first lien, because we'd lose control at that point. We have to either, to save our capital, we would have to pay off the first lien holder. And if that's too big for us to do, then we could get in trouble. We can go up to a 5-year term. We haven't done, I think the largest we've done is 3 years, I think, right, Amin? About 3 years is the longest maturity. And it also has extensions as well, just like the high yield fund. And so here's the net yield to investors chart. So this is net yield. So 12.25 was the semi-annual June 30th amount to opportunity fund investors. So if you had $100,000, you'd have gotten 6,001 something. Right? So on this, you'll see, if I take out the first, because that wasn't a complete 6 months, if I take that out, the last 3 is 11.65. Historically, 10.26. But I see that my trend now is because of the way you have to get velocity on these, and you'll start seeing these two, 13.1 and 9.6, you'll start seeing those get more level, I guess, and not dips and peaks and valleys as we get more velocity. What I mean by that is we're originating and exiting multiple times in a cycle. So assets under management as of June 30th. Total funds, $10.5 million. So we really have increased since 12/31/15. This is, you can see, spread across two main asset classes. You got residential new construction. So basically in this, it does no construction per se loans. So when you see this on there, it's basically helping secure for the acquisition, giving the funds necessary for acquisition for the high yield fund to then do a construction loan. Same for the residential land development. So here we've gone up to 10.5 million in since December 31st.
What's the difference between land development and new construction?
Land development is horizontal. Residential new construction is vertical. So basically sticks versus infrastructure.
Street ditches and power.
Yes. Which, as you know, as most of us are plugged into this area here, buildable lots are, at a premium. The big boys are fighting, wanting buildable lots. There's not enough dirt out there. So here's, sorry.
On the land development part of that, you consider loans from raw land all the way through it's laid out in lots, platted out, ready to go?
Yes, sir.
Okay.
So here's some stats. So growth in the last 6 months. We went. I guess we were around the right at 7 million. So we grew almost 3.5 million, 49% increase. Obviously, if you think of, obviously, when you're that low and you go just that little bit, it's going to make a big increase in percentage-wise. But yeah, still great growth. LTV 72%. Keep in mind this one is our max at the portfolio is 80%. So we're still got room. But keep in mind we are in a second position in this one at sometimes. How much did we originate in the first half of 16 was almost 2.5 million. We've originated so far this second half of the year is 325,000, and we're currently underwriting 2.1 million. So loans exited since July 1st, roughly $500,000. So we're starting to get, we're starting to get that velocity, and we have more stuff coming, exiting. September 30-ish, basically $4.5 million will exit out of this fund on one of those land development loans. So we're starting to see that velocity even more on this one. So like I said, those peaks and valleys will start to flatten out. So now I'm going to move into the high yield fund. So again, Regulation D security, 50 states, organized as an LLC in Texas. Investors are members, and it's owned by the investors. Same thing, we're not leveraging. Will not leverage. We're established in 2008, so it's been around the block for a while. 10-year extension in 2038. I skipped one. I was talking on the phone. It's not too long. We'll hit our 10-year anniversary mark, and it's hard to believe that we're almost halfway through this thing. If we only, depends if we keep going. If we do the 10-year extension, but it's been almost 10 years. It's hard to believe. So and then if we do the 10-year extension to 38, which the managers can do, and then the majority of members may extend beyond that.
The extensions beyond that, would those also be in 10-year increments?
I believe so. Believe so. I hope maybe I can retire, but maybe not. I don't know. I got 3 kids to put through college, so I don't think it's.
Just curiosity on my part.
Yeah. I don't know. So the terms on this. So 9 to 18 months are typical terms. Up to 3 or 6 month extensions. So 9-month loan. Probably in that we put in 2 3-month extensions. Each extension is 3 points of the loan balance. So that's where we get some extra money into the fund that helps increase the net yield to investors. Max 70% LTV. How do we get the ARV means after repair value. So we always require independent appraisal by a certified appraiser. We don't take BPOs, we don't take CMOs, none of that. We want somebody has a license, stamp it, here's the appraisal. And it's an appraiser that we have to approve as well. We do not pay for it, the bar pays up for it. Jerry, did you email me a good question about that?
Yeah, previous meeting.
Yeah. Interest range, 11 to 13%. We've been at this range for, gosh, 3-4 years now. Originally, when we started, we were at the 14% mark, but then, had to do some rate compaction there because of a lot of money on the street. But it's been this 11 to 13% range for going on 3-4 years, probably 4 years now. And again, 3 lender discount points at origination, so that's what helps kick up the net return to investors. Net yield to investors over the last 3 years. Yes, 3 years. So we've only had 1 quarter that was below double digits, bless you, 9.3. Since then, you know, we've been in the low teens, and this is kind of where where I see us staying. You know, that 11%, hopefully get into that 12% as we get a couple of these REOs off the books that are under contract, and you know, making some good loans and getting that capital back working again. Historical yield 12.99. For those of you that were in at the beginning, you remember the 18-19% at the very beginning, so that's kind of what's still driving that up. I think if you look back, I think I wrote it down somewhere, but I didn't bring it. But the last 3 years, we're right at that 11% mark, or last 2 years, I should say, that 11% mark. So I hope we'll stay in there based on the market conditions and some good loans that we're doing. Assets under management. We're at now almost $85 million. At 12/31, we were at $64 million. Now this is skewed a little bit, the total funds. This was at June 30th. Since then, we've had a payoff of a loan that's $10 million of that. So but we've made some other loans. So we're in the high 70s is where I'd say today, 77, 78 million. Some of you may remember I talked about a Cedar Park commercial loan that we did, we funded. They closed on their construction loan, $5 million construction loan, and it was appraised at roughly $10 million. Then 3 months go by and they have not submitted plans for permitting. And I didn't, well, I shouldn't say 3 months. 3 months went by. I had no communication with them. I kept along the way. We're gonna get it into permitting. Cedar Park. What's the status, John? And I kept getting the hem-haw about it. So finally, I had our transactional attorney draft a letter. Either you submit or we're going to foreclose. So they paid us off. So we were in that loan for 4 months, I think. So it was, we want movement. We make a construction loan. We have the money sitting here in escrow to go out. If it's not going out, what happens to net yield? And net yield, it goes down. But I have to have the money to fund the loan. So that's why we put a 30-day 30-day clause in there. If they stop construction for 30 days, well, technically they didn't start. So, And I'm not. It's not day 30. It's like, I gave them plenty of time. But anyway, long story short, that is now roughly in the high 70s because of that payoff. So I just wanted to be clear. And that loan was in the commercial construction, which is at 28. So that's down below 20 now. So that's that's a little bit. But we've got some more stuff coming down the pipe for that as well. You can see that we're pretty solid with our reserve account, 4.8 million. So we got plenty. You got plenty in reserve. Rainy day fund. Also, non-performing, 0. I'll get into the REO. That's crept up a little bit, but we've got stuff that's going to close before the end of the year. Cash on hand, a little over $2 million. So, roughly about $7 million if you count the reserve account. So we've got cash. Not too much cash, but we do have. And when you look at high 70s, almost 80 million in assets, we need to have cash on hand, especially in reserve. REO. We foreclosed on this after bankruptcy. It's gone, paid off. We sold it. So South Austin White House, it was foreclosed project early 2016 after years in bankruptcy, having to go up to Dallas because they filed it up there. Meritage Homes did the the large tract in the back that was almost 5 acres. And that when they did that, we got a big portion of our loan, of our capital back. And then most recently, when we foreclosed, our asset was recently sold to a local developer. So we received our funds back, our capital back. We didn't lose any money. We didn't gain interest on anything. Our money wasn't gaining interest during the interim, but we didn't have to write off anything, so that's good. Laga Vista, remember the convenience store up in Laga Vista, real estate owned. It's the oldest remaining REO. We dated back early 14. This is the one that's the previous, the borrower did a under market lease that we got stuck with for the convenience store. And now the convenience store is fine. They are under contract to buy it. We're looking at closing early fourth quarter. So this will get off the books. And this represents $1.2 million. So that's good. We're moving that off the books. We were receiving income too across on this on a monthly basis. And then we have our Fulshire, down in Fulshire, our 2 buildings down there. Multiple tenants in building 1. Lowe's just recently went in, put a hiring center in there. They're opening a store down there. It's growing down there. I think it's about 20% of the remaining 40% of the building that they're taking for their hiring center. We're still working on the contract to sell building 2. The city down there is worse than this city of Austin to get anything done in planning and zoning to replat, but we're still working on that. Jim Gartrell is our engineer down there, and I think he's getting balder and grayer every day trying to get this done. I think I am too, but anyway, hopefully this is going to move off next quarter, first quarter of 17.
Rob, the replatting was to break the 2 buildings into separate entities?
That's correct. That's correct. Learned a couple of valuable lessons on this deal. Don't take pre-leases because they can be forged, can be false, which I learned, and also multiple buildings. I mean, like this is one plat, but it's a little different with this building. It's one owner. This one, should have never been one plat, 2 buildings. So anyway, we'll get through it. We're not losing money on it. It's not driving down. The tenants are, paying. It's a triple net lease, so we're staying afloat with it, and just looking forward to exiting.
When one of your assets isn't performing like, or the loans isn't performing like you want it, is the borrower paying additional penalties and fines and fees and that are accumulating?
That's a good question. So when we service loans monthly, and some loans have built-in interest reserve. So we're really just at the funding of the loan, whatever those dollars are, prepaid interest, they go in as a liability, and then we take it down each month. So there's really no servicing, so to speak, with the borrower. But the other loans, they have to service the debt on a monthly basis. So we invoice them. Per the loan docs, they have the 5th of each month to pay. If they don't, then it's a 5% penalty. Then if they don't pay by the 10th, then a demand letter goes out. So we're, that communication, we're following through. And then if they're not, we try to give them a little time, but we got the foot there, on the gas, because we need, we want everything either performing or we're exiting, or we want to make sure we're securing our asset, our capital.
But if the borrower isn't saying, okay, so I'm sorry, take it back, foreclose, whatever, is there language in the loan docs that says, okay, fine, but in addition to that, you're going to get X, Y, Z kind of penalties?
Oh yeah, they guarantee, personal guarantees on the loans, so that there's also Some of them, most recent we haven't had, but, or I should say, most recent we have had the language deed in lieu of, so we can get outside, get away from the foreclosure. You don't have to go through that process, require them to do the deed in lieu of. You know, easy strategy for borrowers to throw it in bankruptcy. We've had to deal with that, you know, in the past. But you know, penalties, yes, definitely. And then we've got a judgment on one previous borrower, 1.4 million. So I'll get into that. It's an REO, new REO, but we have a judgment on that. So there's penalties. You know, I mean, if you're not going to pay, there's no handouts. Definitely. I mean, you know, definitely no handouts. We're not. I'm not going to get into politics, but anyway. So I think I went through this one here, so I'll move on. This 5.6 acre tract over on East Austin, 12th and Hargraves. It technically really didn't foreclose. It was at the steps to foreclose, and two local guys paid us off 4.4 million. Then we got two cashier's checks, 2.2 million, and said, "Here you go," and off they went. Off I went to the bank to put it in. So, you know, that it was a non-performing at the beginning of the year, and that tells me right there that our lending parameters work. We did a loan based on an asset. This was a land development, so it really wasn't a contractor yet. It was mainly going from raw land to paper lots to then that, so it was kind of a phase type. So there was no contractor per se to underwrite. But then the exit strategy. Exit strategy was to move into developing the land or to sell it once paper lots were there. So the borrower failed, but the asset didn't fail. And we didn't lose a penny. We could have probably, if we would have foreclosed and put it on the market, we probably could have made quite a bit of money. So I was kind of, you know, oh darn, I wish we could have gotten that one. But, you know, we got our money back and moved on and made it. And that's what led us to make the Cedar Park deal and generate some income off 3% on that large loan, which helped this quarter. So it all works out in the end, as long as we're keeping to our parameters and you know, not raising lower the bar.
Rob, in this particular case, obviously as you go through where you're having a struggle with the borrower and they get into default penalties, we the fund has an intrinsic building expense as you move to the moment of foreclosure.
That is correct.
In this case where they said, no, we'll pay the loan off, does that include our accrued expenses that they paid off, or is that just something that went into the breeze?
No, we received everything back, attorney's fees, going to bankruptcy court, everything. Now, I didn't get a penny more, because if I got a penny more, I have to give it to the borrower who failed. Yeah. That's law. But no, everything that we spent or should have received in income during that time, we got. So we made money. We also were reimbursed money, and then we're able to go out and.
So even though the loan paid off, we don't have any net loss?
No net loss, okay. Not at all. Now, we could not get default rate of interest. In bankruptcy, you can't do that. But, I mean, the legal bill was pretty high. I mean, 50, 60,000 just to, you know. But when you're dealing with when you're dealing with a $5 million, or it's not five, so it was 3.8, 3.9. I mean, you're going to spend 50, 60 to protect your asset, your capital, because I don't want you guys mad at me and coming at me, so, or my wife. So anyway, so we're going to protect it. Oh.
You just have to attach, so that's why
So it's gone. Thank you, Tibet. So anyway, what's been going on? REO property sales, you can see we've been working hard on that, getting stuff out of here. Loans in New Braunfels, we hadn't been a market we've been in. We kind of, how do I say this without, we were able to refinance a local private lenders was the original lender on this, and some of you would know the person. I'm going to keep names out, but anyway, they weren't performing as a lender. The borrower came to us, said, "Can we help?" I know most of you probably know New Braunfels is a very hot market down there. I think it's the number one growing market for that little the size of it. For that in the U.S. So it was a no-brainer as long as the asset, the contractor, and the exit were all in line with our lending parameters. So we did that refinance, and then we also with the same. That was 3 lots down there, and then we also did just recently closed 3 more lots for this builder down there. And you'll see opportunity fund on the refinance 835, high yield fund, which is just construction dollars, was 840 because we're refinancing, so that's why it's kind of a 50-50 split. The new lots was just for the acquisition mainly. So that's 325, and then you got the construction dollars to build these 3 homes. Some updates on North Carolina. A lot of you were very active in the Raleigh, the Durham, the Research Triangle there, Charlotte. They're trying to. We keep going back and forth on who has the best market. Some publications say they do. Some publications say we do. It's almost a mirror of each other. So we're blessed to be out there in that market. I traveled out there quite a bit. Probably every 6 weeks I'm out there checking on things, looking at things. And we're in communication with them, their group, their team on a weekly basis. We have a conference call every Tuesday morning at 8 o'clock. So Amin and I are on that conference call. So we're really communicating with them, following them along the way in every process of each loan. So here's some pictures from North Carolina. So you will say, well, what's going on up there? Okay, so they're building out in North Carolina. I think the first
5.
The first 5 there are, the first one is a Ramsley. It's known as Ramsley. That's in Chapel Hill area. That was a development loan that's now turned into a residential new construction loan, vertical. So they sold off 4 of those loans to another, 4 of those lots to another builder, and then they are constructing 12 basic homes there that you'll see, and these are the first, this is 2 of the first 4. First phase is 4 of those. So they're out there. Chapel Hill is the first little cut development they've had out there since I think 2008 or 9. So it's they haven't had a lot of activity out there. They've had some apartments and stuff and single family, but not a true neighborhood. The other couple here that you see, the next 2, Armour Street, that's in right next to Davidson College. It's an end. It was basically a cul-de-sac that basically just dead. It was just there, 4 lots in a row, and 2 of those have already paid off. They've sold them. Another one's under contract, and so that will leave just 1 left out of those 4. And then some renderings of some. What are those?
That Corbin?
Yeah, so we got a subdivision in Corbinton, which is still in the Research Triangle area of North Carolina. It's plotted, it's a subdivision, 72, I believe, lots. It'll be a mix of product there. They'll have cottages, which is kind of hard, but a cottage to them is what you see here. They have a couple, some duplexes, and then some single family. I look at this, I'm thinking, well, that's single family, but they call it those cottages. Basically, just think of a garden home. Our garden homes is what they call cottages out there, so a little different. But we haven't closed on that yet. We're into underwriting, and I'll give you some figures on that in a minute. Cedar Park. It's a land development loan up in Cedar Park, 56 lots. We're weeks away from substantial completion. Dries Homes is under contract to buy all 56. And then here's some stuff in New Braunfels down there. That's the 3 that we just refinanced. And That's in Vintage Oaks. Vintage Oaks, if you want to look up that. Vintage Oaks down there in New Brunswick. It's a big development. So some stuff in the state of the market. So local builders, monthly survey of local builders. This is Eldon. I stole some from him. 2016 sales through June were up 23% of 2015. You know, it's the strength of the new home market here. We got some stuff from North Carolina. Well, here's where the fastest growing. Kyle, Bill, myself, we kind of battle on this. So Raleigh's number 1, Austin 2, Charlotte is 5. So we're in 3 of the top 5 markets. So, and then I want to give you some stats. I didn't quite finish my stats in time to get them to Tibet. But the high yield fund, since December 31st to June 30th, the growth 30%, almost 31%. Now, keep in mind that 10 million is these are kind of skewed a little bit, but still 30% growth. So come back just a little bit. LTV as a portfolio, 55%. So we're really strong where we sit when our portfolio as a whole is 55%. So what does that mean? That means we could take a dip across the board of 45%, and we wouldn't lose a dollar. Originated through the first half of the year in the high yield fund, just shy of $15 million. Originated thus far, quarter 3, so what, a month and a half, 2.2 million. And we're currently underwriting 6.7 million. So that's great. We're making loans, we're growing, but how much have we exited? $11 million. So we've exited 11 million, and there's going to be another 9 million exit on the books between now and the end of the year. So there's the velocity: making loans, loans exiting. So, you know, all in all, I mean, I think we had a good first half of the year. I think we continue pushing forward with the second half. I want to give you a couple of updates on the REO that we have. We had to foreclose on the Super 8 hotel out in Midland, Odessa. So we're now the owners of that. I've got in contract talks with 2 potential buyers. One of those is, I just got word that they just were approved with Wyndham, the flag. He's a local doctor out there. So he's been approved to basically have a flag, and what means, you know, corporate can put their name up there. So we're looking at hopefully exiting that between now and first quarter. And then we have, like I said, the REO of the Laga Vista. So of that 11.5, 8.9 should exit out by first quarter 17. And then we'll still have left the 1 Fulshire building down there. So all in all, I think we're like I said, we're in good shape. We keep pressing forward, and I appreciate everybody's trust and confidence in us. Just want to give a direct deposit update. So the direct deposit will happen, I promise you, September 30th for the high yield fund. It won't happen on that date, but it will happen for that quarter. So it will happen in October, hopefully by the middle of October is what we'll get it. And then the opportunity fund would be, you know, the first of the year 17, because it's on a semi-annual basis. Self-directed IRA accounts. Some of you, we had a little fiasco with that. They moved and the address wasn't updated. I personally delivered those checks 2 days ago. But that will for those of you in self-directed IRA, I should say, as your custodian. But that will include those. So direct deposits will go to the custodian. And if you have not, I know we had a few that were still, I don't know if there's still any left, but we didn't have all the information on ACH, direct deposit information. So if you haven't sent your stuff, please do, okay? Any questions?
Right.
I have two questions. Sure. Can you address loan demand? And then secondly, do you see any legislative or regulatory threats to the business?
Loan demand. Amin and I talked about this 2 days ago. We are it's still very. I mean, there's still a demand out there. I'd say it's really about the same. Across my desk, I don't see as much because Amin filters it. But I think what were the numbers you gave me?
We do about 5 to 6 loan worksheets a month, and we give out around 2 LOIs that get executed a month out of 4 LOIs.
So what he's saying there? So when a potential borrower comes to us and says, "I got a deal," so if it meets our lending parameters, I know early on, then we'll issue and we like it and fits the portfolio. Then I'll say, "Amin, work up a loan worksheet," and it's a preliminary, and so we put in there, loan them out, and basically what we want the borrower to see is how much money they're going to have to bring to the table. Because if they're not comfortable with that, or they don't have the cash to do that, then it stops right there. So we're issuing about 5 to 6 of those a month, and then once we get an okay from them that they do, and if we're kind of, not feeling, maybe they don't present themselves as having that, I'll say, where's the proof of funds? Because we don't need practice in doing an LOI. I mean, we've done enough of those, so we don't need to practice on how to do it. So anyway, so we move in, it's a process. So basically we're doing probably 4 LOIs get sent out, and like you said, 2 are executed. And I think the stats, and I read those off, so you don't really see them, but I'll get those out. The stats really show that the demand is still there. This is velocity going. Legislature, Dodge, we're still, the Jobs Act kind of was affected the industry here, this industry. But for us, the high yield fund really wasn't impacted because it was already established. The Opportunity Fund, it just really made us zero accredited. We cannot take unaccredited investors. Now, going forward, if we were to do another fund, which I don't have any desire to, but the fund manager has to basically underwrite each investor. So basically, if you put down that you're an accredited investor, I have to audit you. And then if I say you are and you're not, they come after, the SEC can come after me. So the environment we're in now is the investor takes that responsibility. But I don't see, unless I'm missing something, I don't see anything that potentially could hurt us. We have a securities attorney, that informs us of any kind of changes. And I was balking at the bill a couple months ago. I said, "Well, what did you update us on? What changed in the industry?" She's like, "Well, nothing." I said, "Well, why am I paying? Why are you charging me?" So, does that answer your question, Greg? Okay.
Well, this dovetails into his loan demand question. I was curious to know, how do people know about you? Do you do any marketing? And with the banks not loosening their purse strings and yet construction demand increasing, do you have more competition for private money lending? A lot of other firms coming into Austin to do this business, and what are their interest rates? Because I think the bottom line is, you're talking about that 11 to 13% interest rate, and the pressure on that is from competition that you might have, I would imagine, from other lenders. Is that true, or
That's
how many lenders are there?
That's true. How many lenders are there? That I don't know, because there's some checkbook lenders out there, that you don't know about. But there's probably 4 to 5 of us in town, but we're the only true fund in town. The rest of them are doing fractionalized lending. So that means you and Kim and myself are going on the deed, we're the lenders, 33, and 33%. So they're carving it up. And so your risk is, on that property. Whereas in the fund, it's spread across, it's a pool. So we're the only ones that really, a couple of them have it, but that's not what they don't, the majority of their business is not that. So I would say that, when you look at that, we are kind of the only game in town is that for investors. But a lot of people, want to be involved. And there's some of you, investors here that are, do fractionalized lending, and that's great. They want to take a more active role. They want to underwrite each deal. That's great. As far as how do people know about us, find us? I don't like the spotlight, but like stuff I've been in recently. You got a good product, you got a good thing going, people find you. But to really answer your question, we did a lot of SEO work when we did a name change. We were already doing SEO work previously, but when we did a name change, we did that. Tibet's been working hard with getting our name out there, social media, local organizations like the RECA, Real Estate Council of Austin, Urban Land Institute, Home Builders Association. So we're out there in the market. Amin does networking on a couple times a month. So, and then it's word of mouth. I mean, we do not do any advertising for investors. It's been, organic growth, which is good. So, does that answer make sure I got Richard?
What's the opportunity of getting those K1s out maybe like February?
I think really strong. We're gonna
have a good team this year.
Yeah, we're changing up our accountant. That's the last professional that outside of our securities attorney, we haven't changed that, but the tax accountant, once we get through with tax returns, corporate and personal, but anyway, corporate's due in a couple of weeks. Then we're going to be moving in. So the end of this year that we're in right now will be with a new tax firm, accounting firm, and so they'll be getting them out faster. It'll be more professional type thing. Okay. It's kind of what I inherited, what was there, and so it can only change so much, at the beginning. So, but we're working through that.
Yeah, this is the real important. I mean, I invest in a couple of people that cannot do extension.
Yeah, I know what you're talking about because I was privy to that conversation. Yeah. But it's odd that in that organization or division of the government that they work for is like that. But anyway.
Yeah, but they don't make sense.
No, it doesn't. But I'm going to be started there. Anybody? John.
Hey, well, I was going to ask, on the website, we're seeing like either duplexes or houses that are being redone. Are those, who owns those? The Opportunity Fund or these investors that are?
So we make loans on projects. So if we a bar, so if it's owned by the bar. So I think if you're talking about
Monroe Street.
Yeah, Monroe that's CCG Development, and that is a loan through high yield fund. So we set the lending parameters and we meet the lending parameters and we pay 11% interest, just like.
The Opportunity Fund then itself does not do like reconstruction or new construction?
No, it does not. That's why we wanted to be, didn't want to ever, well, you cherry pick this one for this fund, or you cherry pick that one for that fund. No, we don't want to do that. It's conflict of interest. Even though it says in the documents, but still, no construction. So that's what we're doing.
What's the investment criteria for the high yield fund?
I'm sorry?
The investment criteria for the high yield fund?
Per the SEC guidelines, net, income 200,000 single, 300,000 married, or $1 million net worth, not including the homestead. Or if you don't meet that, you're a sophisticated investor, whatever that means. You can come in as an unaccredited for the high yield fund. Opportunity fund, you have to be an accredited investor. For the $50,000 for both.
Cool.
I have an important question.
Yes, sir.
Are you going to have chocolate chip cookies at the Christmas party?
Yes, sir. and I'll spare you all. As much as I love my kids, They're not going to come this year. It was a little too much last year. So you know, maybe we'll put a couple pictures up there. No, I'm just kidding. But yeah, so I apologize last year. It was kind of a little chaos, but yeah. But anyway, I'm glad you said that. We're already working on that. We're going to go back to the same place we were last year out there at the Hills Country Club, and hope that's, you know, okay, and not going downtown like we have in the past. And so it seemed like a good event last year, and we'll be back out there this year. And look, I think. Yeah, we'll definitely do that. Yeah, that was, sorry, but I didn't even know that. But I think we're looking at December the 7th, I think, is kind of a tentative date, December 7th. But, you know, official stuff will go out on that. Is there anybody else? I appreciate everybody coming. I think half of them left, but I understand it's getting late. People got to get back to work. Thank you, everybody. Appreciate it.